Welcome to the On the Edge podcast with your host, Scott Groves.
Hey guys and gals, it's Scott Groves with the On the Edge podcast. I'm here with my friend and fellow Go Abundance member, which we'll get into what that is shortly, Andrew Cushman. And Andrew is a property syndicator, which I think is one of the most misunderstood job titles, way to make money, way to put money into an investment type things that you'll see on the internet. There's a lot of horror stories that have put their money with property syndicators. There's a lot of people that do this job that don't know what they're doing. I can tell you Andrew's track record is phenomenal. So I'm looking forward to learning from him and learning more about his projects and how he invests other people's money. Because in full disclosure, I'm thinking about writing him a check for about $50,000 or $100,000 here in the next couple of weeks. So this was an opportunity for me to bring his story to you and also get a chance for me to vet him even a little deeper than I already have before I give him a giant check out of my savings account. So Andrew, welcome to the show, and let's go right into it. Like, what is a property syndicator? What is it that you do to make money for yourself and other people?
Well, yeah. Yes. So this is live on air due diligence on your part, right?
Yeah.
So you know what? Okay. So a good way to think about syndication is this, and this analogy may apply better if you take COVID out of the picture. But if you wanted to go on a cruise, right? You are not going to go spend $2 billion to buy the Princess of the Sea so that you can, cart around the Caribbean for 2 weeks and then come home, right? Rather, what you're going to do is you're going to find somebody else, a cruise ship operator, that buys the ship or builds the ship. They're experts at managing it. They're experts at running it. They know where to take the cruise ship, right? And then what they're going to do as the cruise ship operator is they're going to think of anyone going on the cruise as an investor, and all the investors pool their money together, give it to the cruise ship operator, and then the cruise ship operator basically takes over and does everything else. And what happens is each of those people who spent a few $1,000s or whatever on the cruise gets the benefits of that cruise ship that they would not be able to get on their own. They get the benefits of the operator saying, oh, hey, these are the places that we're going to go. And by the way, we've set up all these opportunities that you can experience these tours and these places and all that. And so each person who's going, in which is basically kind of like the investor, gets all these benefits that they could not get on their own. The cruise ship operator gets the benefit of, if they do a good job, having an asset that produces an income stream for their business, right? So it's not a perfect analogy, but that's the way to look at it. What a syndicator is doing is pooling together other people's money so that those people can get access to investments they otherwise wouldn't be able to get access to. And in the sponsor or the syndicator's case, in many cases, they're able to buy an asset that they otherwise wouldn't be able to purchase. So, for example, we closed one in March that was, was a $49.8 million deal. I cannot buy that personally on my own balance sheet.
Let's not gloss over that. You guys bought a deal in March that was $49.5 million.
49.8, yeah.
And what was that? What did you buy for? We'll call it 50 million. I think at that level you can round. What were you responsible for buying for $50 million?
It was 252 units, average year construction, 2011 in Fort Walton Beach, Florida. So it was a property that had a lot of upside in a very strong and rapidly growing market. So that it's just a great medium and long-term investment. And again, something I couldn't buy by myself. None of our investors could buy it by themselves. But if we pool our efforts and funds, we can buy it, and then we can all benefit. So that's what syndication is.
Yeah, because a lot of people who are probably watching this work in the mortgage or real estate space, because that's probably where I have influence. And so I just want to do a little thought experiment of, like, if you're buying my neighbor's house, okay, and you're buying it for $500,000 and you're paying $600 for an appraisal and you're putting $100,000 down. And, that's kind of the scale of what a lot of people think about when they think about doing property investment. You pay $600 for the appraisal, maybe a total of $10,000 in closing costs. And you buy this place, you put $100,000 down, you put a tenant in there for $3,000, $4,000, maybe you make some money. Can you explain, just extrapolate that out to the scale of a $50 million property? Like, how much money are you putting down? How much money is out of pocket to obtain that property on closing costs? I'm guessing an appraisal doesn't cost $600 on a 250 unit building. Like,
No, it does not.
how does this scale up? Because like you said, really, unless you're Warren Buffett, the only way you can think to purchase these things is if you get into a syndicate and me and you and David and Mike and everybody pool our money. And then it's like, all right, we got the whatever you're going to tell me, 10 million or 20 million to buy it. Can you just talk about the scale of closing on a $50 million property?
Yeah, you've got to add a bunch of zeros to all the numbers that you just mentioned, right? So we just applied for a loan a couple of weeks ago. The loan application fee was $75,000.
Wait, what?
Yeah, that's the fee just to start the loan, not to guarantee you get it. Just to apply for the loan is a $75,000 fee that you're not going to get back, by the way, if they decide to not give you the loan.
Whew. Okay.
And then I'm trying to think. Our earnest money, So on that deal we talked about earlier, the 49.8, our deposit on that, our earnest money deposit was $500,000. 250,000 of that was what we call hard day one, meaning it's non-refundable no matter what, unless exceptions for fraud or environmental or something like that. But basically, we can't just be like, we changed our mind. And if we did, the seller would keep 250 grand, right? Appraisals can be, surveys and appraisals, those can all be anywhere from $8,000 to $20,000 each. You may be hitting six figures in legal bills. Between the lenders, lawyers, and your attorneys, and then third party, and then due diligence costs. So that is the risk of being a syndicator and a sponsor. Is investors' money does not get used until the day of closing. It can only be used for closing on the property. You can't use investor money prior to closing because there's the risk that it won't close. And so if you're considering syndicating, that is actually the biggest risk. Is as the sponsor, you have to front all of that money to get the deal done. Now, once it closes, that's considered a reimbursable expense of doing the deal. So it's not forever out of pocket. But if something happens and it doesn't close, you lose all of that and you have to move on to the next deal.
So if you're like on that deal you were talking about that you closed for 49.8, if you're putting, $75,000 application fee, appraisal, legal, $250,000 portion of the good faith deposit that's hard on day one, Andrew and his team and or your company, you might be all in for $500,000 of non-refundable money before you know for certain that property is going forward. Is that correct?
Unfortunately, yes. That's one of the bigger risks to the business. Yep.
Ooh, all right. So that leads to the obvious question, because nobody wants to, put it out there and get it chopped off. How do you make sure that you're under contract for the right properties? I mean, that's got to be where the money's made, right? Because you can't just like kick the tires on 4 or 5 properties and lose $500,000 each. How do you locate? How does Andrew locate? Well, first of all, let me ask: are you the one that locates the property? Is that your zone of genius in this enterprise?
Yeah, that is. Well, it is definitely. I do consider that one of my zone of geniuses, or zones of genius. I guess as I said, right? Not zone of geniuses, zones of genius. However, I can't take credit for developing it. I've learned it from much more experienced people than myself over the years, and that's one of the things I love about real estate. Is in the corporate world, R&D stands for research and development. In real estate, I say it stands for rip off and duplicate. And what I mean by that is not a malicious thing. Is that everything's been done. There's really not anything new in real estate. In order to succeed, all you need to do is find someone who's already successful at what you want to do, go learn what they're doing, and then go home and duplicate it, right? There's a big enough market. There's room for everybody, right? So 99% of what I talk about, I've learned from people smarter than me over the last, 13, 14 years. But no, we have a very strict and well-developed screening procedure that tells us, not only what properties to buy, but what submarkets to be in, what macro markets to be in, and what states to be in. So there's a very strict process that weeds out the vast majority of what we look at. For the last 2 deals that we're buying, we're averaging having to analyze 220 properties to make 28 offers to buy one, right? So, there's a very, very strict, well-developed process to weed it out, to make sure that once we go under contract and all that money is at risk, we already know with a high level of confidence that we want to buy this property. Now there's stuff that comes up in due diligence once you're walking every single unit and researching the title and all of that. There's two of the ways we mitigate that is, one, we always have just unallocated reserves. So if there's $1 million renovation budget, we might, in the beginning up front, there might be 200 of that allocated to crap we're going to find down the road, but we just don't know what it is yet. Right. So you always have cushion built in so that if one thing goes wrong, it doesn't blow up the deal. Yeah. And you have to underwrite to that in advance. And then also a good contract attorney and good negotiating. So there are, slight variations in wording and contracts that can give you an out if need be. And then we do have carve outs. I mean, when I say a carve out, it's basically an exception, right? So when I say, okay, we've got $250,000 of deposit, non-refundable day one, except if the seller commits fraud, if we find something wrong with title, or if there's an environmental issue, right? So what it basically means is, we do have an out if there's something truly wrong with the property, but we don't have an out if we're like, oh, you know what? Yeah, we just don't like the neighborhood anymore. Like,
these numbers don't really pencil out for me. I'm going to go ahead and step away. And it's like, all right, well, we're going to keep your $250,000.
Exactly. Yeah. That's what's going to happen. They'll keep it, and that's it. So,
and I want to go back to these numbers. I wrote them down because they're striking to me. In the residential side of real estate, I know realtors who are like, oh God, me and this client are on our fourth offer. We've seen 20 properties. I just want to stick a pen through my eye. But you guys evaluated like financial valuation, location, market, average median income. You guys did a deep dive on 220 properties to make offers on 28 of them to get one accepted.
That's what we're averaging for the last, I'd say, about 18 months. Yeah.
And is that because of those 220 projects, there's not enough upside, sellers want too much money? They're like, what is it disqualifying? What's the number one disqualifying factor you find right now? Because obviously the residential real estate market is super hot. So I imagine the multifamily property market is super hot, and people are, buying and selling, and they'll overpay by $1 million because, well, fuck it, I got to do a 1031 exchange and I don't want to pay capital gains taxes. So that puts you in a bad spot if you're looking for good value add properties. What tends to disqualify those 220 properties to whittle it down to like, we're only going to make an offer on like 5 or 10%?
Yeah, I mean, there's a laundry list of things that'll disqualify a property, but by far number one is, and one of the things you said, is just pricing. In today's market, and especially any property that gets significant exposure to the market, there is almost guaranteed to be somebody, for whatever reason, who is going to be willing to pay a crazy high price for it. Maybe it's 1031 exchange. And Canada, I see a lot of 1031 people. I'm like, man, I don't know if the tail's wagging the dog. Like, are you buying a bad deal that's going to cost you more down the road? Yeah, you save some taxes now, but I'm not quite sure that in the big picture that's actually going to help you what you just did.
For those people that aren't familiar, can you explain what a 1031 exchange is for the person who's doing the 1031 exchange, and then maybe explain why that might kind of bastardize the prices in the market? Could you explain a 1031 exchange and then what's going on?
So yeah, let's say you bought let's just say you bought a 10 unit property for $1 million a few years ago, and today it's worth 1.5 million, right? And we're going to ignore transaction costs and all that stuff. So for whatever reason, you want to sell that property and go buy another one. But if you pay taxes on that $500,000 gain, because again, this is not your primary residence, there's no exclusions or anything like that. It's a $500,000 gain. If you pay taxes on that, that's going to hurt your buying power. And the tax code really is a list of incentives, right? And so the government wants us to provide housing, so they give you tax breaks for doing that. And so what they say is, all right, if you sell that property where you have a $500,000 gain and you exchange it for a similar or like kind property, you don't have to pay taxes on the gain from the first one, right? That your basis rolls over into the next one. And then when you sell the next one, you'll get caught up on those taxes unless you do another exchange, right?
Right.
And so there's a lot of very, very wealthy people that they just keep doing this until they die. And then when they die, it passes on, and they end up not really ever paying taxes on those gains. So that's what a 1031 exchange is. But what happens sometimes is, and part of this has to do with the rules, is if you're doing a 1031 exchange, there's very specific rules in terms of timing. And don't 100% quote me on this, because I'm not an exchange custodian or anything like that, but I believe you have 45 days to identify the next property, 45 days from when you sell the first one to identify the next property, and 180 days to close. So that puts in a market that's very hot, right? Think about, you're just talking about the realtor who's shown 20 houses and made all these, and they can't get one, right? So in a market that is so hot that it takes a ton of offers and a ton of time to find a deal, what happens is a lot of 1031 people get up against that clock and they're running out of time, and they'll just start throwing out obscenely high offers just to get a deal. And when you look at what they're paying, sometimes it's like, well, wait a second. If you're overpaying by twice as much money as you would have, that you're saving in taxes, it might have made sense for you just to pay the taxes now and then go buy another property and have it over with, especially if capital gains rates are going to be higher in the future. It actually might make sense to pay those gains now instead of at 35% down the road or whatever it's going to be. And I'm not saying 1031s are bad, or that you should never do them. It's just that we do see some people in the market probably not making the best buys because they're just getting a little too focused on the tax aspect and not the bigger picture. But what that leads to is just higher demand in the market and people willing to pay higher prices. And there's other reasons too. Some people have lower cost of capital, right? Like we bump up against hedge funds that can, and different other entities that can borrow money at 1.5%, and they can, if they can get 5 or 6% in an apartment, that's great. That's a huge spread for them. Or money from overseas, they're just looking for capital preservation. They don't want it to get taken from them. They just don't want to lose it. So like, hey, we'll put it in a U.S. apartment complex. We're almost guaranteed to not lose money. And hey, if we make a few percent, even better, right? So there's a lot of that is what makes it so, drives up pricing and makes it so that someone like you or myself is not going to be able to compete with those people.
Yeah, it's funny. I didn't even really think about this because my mindset is still kind of small in the residential market. But when you're working in these, 30, 40, 50, $70 million property zones, you are competing against BlackRock hedge fund who's like, hey, we just got to park $70 million. It's our money. It's free. So if we can make a 3%, 3% multiple on it or whatever, or 5% rate of return, we're crushing it because it's our money. It's just sitting there doing nothing. So you are currently, when you're making offers, you're competing against the Warren Buffetts of the world or the Chinese billionaire who's just trying to get money out of China into the US market. Like these are the people you're competing against when you're making offers.
Sometimes, yeah. And it always blows my mind when we're looking at, a 30, 40, 50, $70 million deal and the broker calls like, hey, sorry, we got an all cash offer, close in 30 days, it's just mind blowing amounts of money. Right. But no, so we actually recently listed a property for sale in Atlanta. And my perception going into it was that a lot of the buyers would probably be, kind of new syndicators, because this was a smaller property, 132 units. We were expecting it to go for about 17.5 million. So I thought a lot of the buyers were going to be kind of new syndicators, people just really excited to get into the game, which is good. But it was rather instructive because at the end of the process, out of the 25 or so legitimate offers that we had, probably only 2 were either local or kind of new or smaller syndicators, while the rest of them were large, well-funded, very sophisticated entities, companies that owned 10, 15, 18,000 units, across the country in the Southeast. And what we observed is these guys are all out there doing everything they can to get their hands on as much real estate as they can. Which was a bit of an insight, like, because, we're always looking at it like, okay, we're 10 years into a cycle, pricing is definitely high. what are the risks going forward? And it was instructive to see, well, okay, the buyers out there, it's not just a bunch of people getting overexcited like it was in 2006, right? Well, your hairdresser, bought 3 houses and then just sold them to the next person for 40,000 more. Like, that's not who our buyers are. Most of the buyers are, again, very well funded, very sophisticated entities. And so what we took from that is, one, like, dang, no wonder it's so hard to win deals. And then number two, if all of these guys with, a huge amount of resources, if they are trying to get their hands on as much commercial real estate as they can, that's probably a good sign that we should be doing the same, but without changing our underwriting standards. And so the solution to that is going back to what we talked about before, and as the market heats up, how do you keep doing deals that are as good as you used to be doing? Well, now you have to look at even more, right? So we used to look at 10 deals to get one. Now it's 200 something.
Yeah. Yeah. And can you go through, by the way, is it public knowledge yet what you sold that $17 million property for?
It's under contract, so I can't quite say, but I can say it is well above that number.
Perfect. So lucky for you and your investors. So talk me through, if I'm a potential investor in Andrew's syndication and you're putting together a $50 million deal, what does that look like for you as far as money down, expected rate of return? How much do you guys take off the top as the syndicator? And then what can the investor kind of expect as a reasonable rate of return? And let's just say you bought it for 50 million and you sold it for 50 million because the market stays sideways. And I don't think you would ever do that. You'd probably only sell if there was a profit. But if the market stayed sideways and I kind of just got my dividend and interest, like, what does the deal look like for you? How much money do you have to put together? And then what can the investor kind of expect as a rate of return for coming alongside you?
Yeah, so I'll kind of stick to general terms. So how syndications work, and there's a ton of pieces there, Scott. So if I miss any, just jump in and say, "Oh, hey,
I'm taking notes."
This or whatever. Yeah, okay. Or if I just wander off track, which I tend to do occasionally. So generally, how the syndications work is, and then how we do it is, I'll start kind of at the top. Is there's either the idea is, investors are getting a return on their money and investment and the risk that they're taking investing in the deal and the sponsor. And candidly, you're really investing more in this person than you are in the deal. A good sponsor can turn a crappy deal around. A bad sponsor can make an awesome deal go bad in a heartbeat, right? So you're really, number one, you're betting on the person. Number two, you're betting on the deal. But how it generally works is there's, the investors come in as limited, and this is, again, we do it this way, but this is almost any syndicator you're looking at in the industry is going to have a similar structure. So as an investor, you are purchasing shares of the LLC that's buying the property, right? So if you're doing a $50 million deal, you might have 50 or 100 investors. You're not going to put 100 people on title, right? You're going to form, my $50 million deal LLC. That LLC is going to buy the property, and then everybody comes in as owners or members of that LLC. So that's kind of the legal structure of it. And so as an investor, you are buying shares of that LLC, and those shares entitle you to a percentage of the profits from operation and from sale and the depreciation, right? And that's one of the biggest benefits of investing in real estate syndication, because you can syndicate anything. Syndication is not specific to real estate. But one of the benefits of a real estate syndication is the depreciation passes through to the investor on the K1. And a K1 is basically just the name of the tax form that you get every year from each of your investments. And so those shares of the LLC that you purchased, that entitles you, like I said, to an economic, percentage of the economic benefits of the property. Kind of going back to that cruise ship, right? You get your room and your bit of the buffet, right? So the typical share is, and how, like, for example, how we do most of ours is 80% of the profit from operation and profit from sale goes to investors. and then 20% goes to us as the sponsor. And that is our financial benefit and gain for doing all of this and taking the upfront risk, finding the deal, and operating it and all of that. In many cases, you'll hear what's called a preferred return, and that industry normal is a lot of times it's zero. It's commonly somewhere between 6 and 8%. But what a preferred return is, that means the investors have to get a certain level of return before the sponsor can get any of theirs, right? So let's just say there's a preferred return of 6%. Then that means, Scott, you put in $100,000 and the preferred return this year is 6%. You have to get a $6,000 distribution during that 12-month period before the sponsor can get anything because of that 6% preferred return. So basically, Scott, you invested $100,000. You have to get your 6% before I can get anything.
So you're getting, it could work one of two ways. Either in that preferred return, I'm getting my 6,000, and even though you're legally authorized to take 20% off the top because you're the sponsor in the LLC, if you don't meet the obligation of paying the investors their 6%, your 20% profit, you just diminish and diminish and diminish. So you're highly, highly motivated to run this as profitable as possible.
Yes. However, you said, even though you're not legally bound, that's not really true, because it's in all of this structure is in the operating agreement for the LLC. A good operating agreement should have this in exquisite detail. These operating agreements will be 70 pages,
right?
But they should all be laid out exactly how it works. So yeah, the investor has to get the 6. And then if you don't get your 6, so let's say their preferred return this year is 6%, and you get 5,000, right? Well, you're short 1%. Now what? That 1% carries over to the next year. So now you have to get 7 to get caught up, right? And let's say for whatever reason the whole thing doesn't work out as planned, and for 5 years straight, you get $5,000 a year,
or you get zero. You can get 0, right?
Well, yeah, or 0, right? So all right, so let's just say you got 0 for 5 years. So now you've got 6% times 5. You got 30% of preferred return accrued. So now when the property sells, if there's enough money, then you have to get caught up on that 30% before the sponsor can get anything. So that's what's called a cumulative preferred return. That's kind of that's pretty, not everybody does it. And there are other ways of structuring it, but that, I want to stick with what's most common for people to see.
Yeah.
And so that's kind of the structure. So there's lots more, so I don't want to give a monologue. So other specific points you want me to touch on?
It's so funny, whether it's GoBundance, the group that we're in, which are men that are, tend to have either incomes or net worth high enough to be able to make these kind of investments, and they're just trying to live life big and be great family men and be great businessmen. A book that's going around in our circle and also Front Row Dads and a bunch of business groups I'm in is Who, Not What. And so I want to go back to this idea of hey, a sponsor can save a shitty deal and turn things around. A good sponsor, a bad sponsor can screw up a pristine deal that should have huge returns. So, I imagine most people come to you and say, well, what deals you got? What properties are you buying? What's the rate of return? What's the operating agreement? But it sounds like to me, what you're saying is hey, it's more about Andrew and their team and the who are going to put the deal together and manage it than whether or not we're buying 200 units in Georgia or 400 units in North Carolina, because the who is going to be so much more important than the what. So can you talk to that a little bit? And I know you're not good at self-aggrandizing or patting yourself on the back, but can you tell us why the sponsor is so important? Because in my mind, I'm well, if you buy a 400 unit property, 10% under market, who can fuck that up? But everybody. Okay, perfect. Okay, so that's the story I want to hear. How does the who affect this so much?
Yeah, so I think that the best way, one of the easiest ways to maybe illustrate that, if you buy a $300,000 house in your standard, tract home development, you can fix it up, you can, make it nice, you can, however, but when you go to sell it, the value of that property really is going to be determined by the comparable sales in that neighborhood, right? If all the other houses sold for $350 and you overspent and put $300,000 of work into an awesome kitchen and all this, you might get a little bit more, but you're not going to be too far above $350, right? In the commercial world, and especially in multifamily, the properties are valued by the cash flow coming off of it, right? What determines that cash flow? How well that property is being operated. So when you listen to podcasts and you hear the gurus and the boot camps and the books, everything is focused on how do you get that deal, right? Because that's exciting, it's sexy. And until you get your first deal, you don't have a business. So there's legitimate reason for that. But the real money in apartments is made in the operations, the asset management and the property management. Because when you go to sell, your property isn't valued. Yes, people look at the sales comps as a point of reference. The appraiser is going to look at that. But how it's actually valued by the market and by the buyers is they're going to take the cap rate in that market, which is, that's not it. Basically, it stands for capitalization rate, and look at what that really is cap rate is a measure of market sentiment, right? So if we say a cap rate is 10% in one market and a cap rate is 5% in another market, generally speaking, the lower the cap rate, that means investors have a higher level of confidence in that market and assets in that market. So if you're selling, a low cap rate is actually, the lower the cap rate, the better, right? And what happens is you take your cash flow and divide by the cap rate for that type of asset in that market, and that gives you your valuation. Okay. So if you have I'm going to try to do math on the fly without having finished my coffee. So we'll see how well this goes. If you've got a $100,000 a year net operating income, okay, which
this is profit on the building, $100,000 profit on the building.
Cash flow, not factoring in the mortgage and depreciation, right? Because that's mortgage and all that. That's finance and accounting. That's not the property. Right. So people are concerned about what kind of income stream can I get from the property, regardless of what kind of debt I put on it. So if you've got a $100,000 a year net operating income, and you're in a market, and if you find one of these markets today, let me know. But if you're in a market where the cap rates are 10%, right, you're going to take that $100,000, divide it by 0.1, which is 10%. Valuation of your property is $1 million. Okay. Now, take that same $100,000 cash flow and move it to in that same asset and put it in another market where the cap rate is 5%. $100,000 divided by 0.05, that asset is now worth $2 million. All right. So that's how properties are valued. So looking at it from another way, let's say you buy a property where the cash flow or the net operating income is $100,000 and the cap rate is 5%. So you just say you bought it for $2 million. If you can get in there and over, a 5-year period, operate it well and figure out how to get that net operating income up to $200,000, and let's just say cap rates stay the same, you just created $2 million, because now $2 million divided by 0.05, 200,000 net operating income divided by 0.05 is a $4 million building, right? So that's why, unlike the single family, in apartments, the operator is the key, because how well they understand the markets, understand the asset class, how well they underwrote it in the first place, and the people they put in place to run the day-to-day, those things are going to determine that cash flow, and that cash flow is going to determine how successful of a sale you have down the road.
Now, I think this is public information, so I'll ask the question. You can tell me if I need to shut up. On that $50 million property that you bought a year ago, was that a year ago?
It was in March of this year.
It was either that one or another one that you've acquired in the last 24 months. you guys went in there, you cleaned it up, you used your economy of scale to get the expenses down and the revenue up, and now your cash flow is better. You shared a success story of a building that, you bought for X and appraised for X, like within a year or two. Was that this building that recently had a large jump in value?
It might be. We've got a handful that fit that description. So I'm not sure specifically which one you're referring to, but I can use that one as an example because we actually just looked at the valuation yesterday. So that particular prop, and I can talk about this because it's closed and no more investors can come in or anything like that. So we purchased that for 49.8, and in the 6 months that we've owned it, our average rent increase stands at $408 per unit. Now it's 250 units, so we haven't gotten that. Not every unit is up 408, but the ones that we have, done a light renovation on are up on average $408 a unit. So so during that 6 month time frame, we've increased the net operating income. Also, by choosing the right market, Fort Walton Beach is a very strong market, huge population growth, strong median incomes, low crime. We're not in a flood zone, a whole bunch of the things that we look at. So we bought an asset in a market that gave us a strong tailwind. So we have greater odds of success, lower execution risk. And then by getting in there and bumping the rents that much, when you combine how much our net operating income has gone up with where the cap rates for that asset is today, if we were to sell it today, it would sell for between $70 and $73 million, right? And we bought it for 49.8 6 months ago. And we're not, we're probably only 25% of the way through increasing that net operating income because we have a whole lot more units to renovate and turn. Did we underwrite that well? Yes. Did we pick the right market? Yes. But part of that's why picking the right market makes such a big difference, and that's why it's important to have as a sponsor or someone who's buying properties to have a disciplined approach to where you buy, because it increases. I mean, it's easy in one sense. Hey, we got lucky, right?
Right.
But by buying that way, it increases the odds that you're going to get lucky.
Right.
Right. I cannot say I did not predict we were going to get $400 rent increases. We predicted 200. I think it was 270. Right. So we actually got it wrong. We underestimated it. But because of the way that, one is, the market shifted for everybody and we're all benefiting from that. And I can't take any credit for that. But part of it too is by being in a market that benefited even more than average, it increases your odds of doing that. So again, it gets down to, back to the original question of you're really betting on a sponsor more than a deal. There are attractive looking properties in all kinds of horrible places, right? So you're betting on a person who knows how to pick the right property in the right market and then operate it well during the hold time. And, that's really what it comes down to.
Yeah. When you gave me, I was at the event in Manhattan Beach that we all went to, and you kind of went through your 10-point checklist of like how we evaluate properties. It's nothing groundbreaking per se, but it's like adding them all together of like median income, population growth, just looking on Google Maps to see if we have more green and blue yardage around us than brown, dead dirt lots around us, just like simple things that anybody could do. But you start to put that all together, and then I can see how you would quickly go from 220 properties down to just accepting one, because, you've got a lot of disqualifiers. But when you go through all of that, luck favors the prepared. You got some tailwind, you got a little bit better rent increase than you expected, and renovated the units well. I'm sure you were able to bring operating costs down because you have this huge economy of scale. And so just for the mental exercise, although your investors are in this long term, any of your investors who put in $100,000 into this syndicate on this property that you bought for 50 and it's now worth 70, presumably their $100,000 is now worth 140 because there's intrinsic increase of value on the property. But on that initial $100,000, what rate of return do you project they're going to get over the next couple of years? Are they going to get a 5% return on their money, based on operating income? Are they going to get a 10% return on their money? Like, what do you think they'll get in interest or dividends, I should say, until you guys decide to sell?
Yeah. So reality on that deal in particular is actually far above projected. I can tell you, what. The actual internal rate of return on that is on track to be probably well into the 20s because of that surge that we've had in the last 6 months. But when we did the underwriting, when we put it out to investors, the pro forma on that, I want to say it was like a 14.2% IRR or something like that, which is crazy because when I started this business, we used to in 2011 we used to throw away deals that were any below 30. Right. If something had less than a 30% annual return, we were like, yeah, not interested in this. Right. And then, now, we're having to look at 200 deals to find something that we truly believe, yes, we can make this, this will deliver a 14.4 or whatever. So, when investors are looking at multifamily syndications in particular, I'd say that the norm is anywhere from 12 to 16% IRR. And that should vary depending on how much risk is being undertaken, right? So if you're buying a A- property in, Austin, Texas, which is probably going to keep growing like crazy for a long time, it's well located, there's not that much risk really in buying that property. So your return should be on the lower side. That might be a 12 or a 13 or something like that. If you're looking at a property that's built in 1972 and it's got a ton of deferred maintenance and it's 30% vacant and it's in the borderline area and the plan is to go in and do a big renovation and clean it up and change the demographic, that can be done. And there's lots of people who've done exceptionally well with it. We used to do that in the beginning of the cycle. That should have a higher return because there's a lot more execution risk, right? So that should be maybe a 15 or a 16% IRR. New development, that should be more like 18 to 22. So if someone is looking at, I think I might want to invest in a syndication, don't just look at the high level numbers. Look at, number one, like you said, kind of the sponsor and what their experience is doing it. But then two, try to look into the assumptions that are going into making that projected return. And then also the amount of again, execution risk, right? Does everything have to go just right to hit that number? Or is that kind of like the base case? And as long as some things go right, you'll hit that number. So that's kind of the standard returns. We like to underwrite between, like I said, 13 to 16. Candidly, if we look at a deal and it comes out to 18% IRR, we're going to go in and just lower the assumptions and bring it back down to probably 15 or something like that. We just don't feel comfortable promising. Well, it's not a promise. It's not a guarantee. It's a projection. We just don't feel comfortable projecting, much higher than a 16 or whatever, in the current market. Yeah. But those are kind of the normal ranges for where the market is today.
Interesting. And, I start to think as you're talking through this about, risk and what's the 2008, 2009 Black Swan event that could, take out Washington Mutual, that could take out these syndicates. And I think the fact that you've weathered the storm speaks highly about you, because to me, in your space, the Black Swan event is the government stepping in and being like, no, you don't have to pay your rent. Like, yeah. COVID moratorium, fuck it. If you don't want to pay your rent, it's fine. It's all on the landlords. So can you talk a little bit about the last year? And I don't want to make this all political, but, what are the ramifications for large, people would look at you and be like, well, you're doing $50 million deals. You're rich. You can afford it. I'm sure all your investors are rich, but I know people that have money in your fund that count on that interest and dividends to pay their bills, And so when we talk about navigating this last year where the federal government came in and told a bunch of people they didn't necessarily have to pay their rent, how did you guys mitigate that risk? How did you weather that storm? Did it affect you? Like, were you peeing in your pants a little bit when you realized you've got several thousand units that might just decide to not pay their rent what happens for you the last 18 months?
Yeah, you gotta love when the government steps in and say, "Oh, contract law no longer applies," right? Yeah. So, and candidly, when they first did that, it was kind of like, all right, yeah, it makes sense. Hey, we got a pandemic, and everyone was just told they can't go to work. All right, fine, right? It's when it started stretching into, month 12 and 18 that's like, all right, guys, and we've got vaccines and we have super low unemployment, and like, all right, it needs to stop at that point. The short version is we actually weathered it very, very well. 2020 was the best year we ever had until 2021, which is blowing 2020 away. So we're having the best years we've ever had in terms of operations and net operating income and all of that. The reasons for that being, one of the, we talked about, Scott, you mentioned the screening criteria, right? And how we have this checklist of like 10 things we go through. One of the things that's not officially on that checklist, but it's a soft requirement, is we buy in areas that we see as having low legislative risk, right? Meaning there's a lower risk of the state, local governments coming in and doing something anti-landlord, right? So we do not buy in California.
I was just going to say, you and I both live in California, and I bet there's a 0% chance that you have anything from California in your portfolio.
No, live where you enjoy living and invest where you get the best returns and the lowest risk, right? So do not buy in California. Do not buy in New York. I could list a whole bunch of cities I wouldn't touch with a 50-foot pole. And so, number one, we were not in any of the areas that kind of had that mentality. I know I've talked to operators who own in, California and San Francisco and New York, and yeah, they really are hurting. So that's number one is we did not own anything in areas that tend to be anti-landlord. So that mentality of, oh, cool, we don't have to pay just doesn't really exist as much. So that was the first thing. The second thing is, yes, there are people, tenants, who are just absolutely taking advantage of the situation, right? Though they definitely exist. The vast majority of people, that's not the case. There are people, the vast majority of them, yeah, they got COVID. They were sick for a month. Or, they can only, their job is, they work, some of the jobs that haven't come back as much are, were the service jobs and until recently, and yet they've only been able to work 20 hours or, they have legitimate hardship. And so what we did with most of those people, basically anyone that would communicate with us and that we felt like were being honest and transparent with us, we put them on payment plans. So maybe they paid 50% of rent for 6 months and then we'll catch it up later. Some people, we just said, hey, you know what? You can't pay. If you just give us the keys, we'll let you break the lease with no penalties, no fees. We're not going to come after you for anything. Just you know what? We understand, tough situation. We'll let it go. And then also, when, there's a lot of agents, even before the various, stimulus packages were passed, there's a lot of agencies out there designed to help people, get behind on rent, whatever. So we would help people apply, sometimes we'd apply for them. And so the net effect of that is out of every 100 units, we maybe only had 1 or 2 people that were just sitting in the units, not saying, I'm not paying and I'm not leaving. Right. And so, that's one of the beautiful things about apartments. If you own a house and the tenant says, I'm not paying, your income goes to 0. If you got 100 units and 2 people say, I'm not paying, you're really not going to feel that. Right. I mean, obviously you want to maximize every dollar you can, but it's not going to, you're not going bankrupt because 2 people stop paying. So even in the midst of the pandemic, even in the midst of the moratoriums, we had a handful of properties that are in the 90 to 150 unit range that had 0 delinquency at the end of the month, meaning every single tenant had paid. And it was just largely a function of trying to work with the residents as best as we can and treat them well. But then also, one of the misunderstandings about the moratorium is it was not a blanket moratorium. It didn't say you can't evict anybody. It just said you can't evict someone who qualifies under the rules of the moratorium. And when it came down to it, a lot of those people who were just like, I'm not going to pay and I don't have to, and I'm not leaving, those folks also didn't want to go get qualified for the exemption. And so we were able to evict them through the process because, we said, hey, okay, in we had to give them notice. Well, all right, if you want to fall under the exemption, you have to, here's the, I forget, it was like seven, here's the 7 things the CDC says you have to do to get exempted. Most of them wouldn't do it. And so, yes, we were able to get them out. And again, this is probably only 1 or 2% of our residents. So,
right.
Why would, so that's part of why our experience was so much different was, again, legislative, being in the right areas, business friendly, to really trying to work with people as much as we can. And then the third thing is, again, getting back to that checklist. When you purchase properties in areas where there's a high enough median income so that your apartments are affordable to the vast majority of people in those areas, those folks can absorb a little bit more of a hit than if you're in a, let's say, C-class neighborhood where, everyone's hand to mouth every week. And if they get a flat tire, they can't pay rent. Those markets, those properties, they definitely got hit harder by COVID and the moratoriums because, for a variety of reasons, those folks, live on a tighter budget and a much tighter, economic status. And it takes less to knock them into, I can't pay.
Yeah.
So again, gets back to screening, buying in markets that give you tailwinds, buying in markets that give you advantages. And I think that those 3 things combined are why, us and a lot of other operators actually ended up doing pretty well.
That's amazing, man. And that really states the case, kind of your home example of rent going to zero if you lose your one tenant. That kind of states the case why somebody like myself might want to go into syndication. So let's say I have $100,000, which I do, that I want to put into some type of property investment. I don't know, I'll pick the wrong neighborhood. I'll pick the wrong tenant. I'll pick a house that has mold in the walls. By the way, these are all things that have actually happened in the past when I've tried to manage my own real estate.
Yeah.
Versus, and I don't know if this is public knowledge, but can you share how many doors your team currently owns or operates, or how much assets is under management? Is that public knowledge or something you can share?
Yeah, we've I think we've acquired about, I think we're like 2,350, something around there.
Cool.
And we have sold some. I mean, we sold off everything in Texas, and we're selling some Atlanta stuff. So I think we currently manage around 1,300 to 1,400.
Okay. Yeah. So for me, it's like, I'd rather have my $100,000 diversified amongst a 200 unit project or a 1,300, unit portfolio or whatever the case may be, because it just mitigates risk. Whereas if I go put my $100,000 into a rental property down the street here in LA, or where we have our second house in Vegas, it's like, I don't know, I could totally choose wrong. And then the market crashes, or the tenant's an a-hole, or I buy a house on liquefaction, or who knows what, and it's like, it all goes away. And so, is the syndication, let's assume you're a trustworthy guy. Let's assume that you guys do good work. Is the syndication set up where somebody like me can set it and forget it, and there's no ongoing headache or legal review, or there's no board of directors meeting I got to go to? Is it just like, hey, Andrew, here's some money. Please go do the best you can with it. I trust you to get me 7, 8, 9, 10%. If we hit a home run, it's 14%, and I end up in one of those Atlanta type deals where, the money doubles in 5 years, great. But I'm just looking for singles and doubles, and I don't want to ever think about this again. Maybe one email from you a year. Is that how it works? Or am I missing something where there's some more proactive activity by the investor that I don't know about yet?
Yeah, the syndications are intended as a passive investment. Part of the idea behind it is, a lot of our clients, for example, are successful entrepreneurs and doctors, people who make high incomes or have a high net worth because of something else they're good at. And they're like, well, I don't have the time, expertise, or the desire to go look at 200 properties. And even if I did, I don't want to have to be responsible for running this thing. So yeah, that's where a syndication comes in, where you say, okay, I'm going to invest 50 or 100 or a million or whatever with somebody that is what they specialize in. And I'm betting on them to send me, a return on my money. And I definitely wouldn't say only look for one email a year. I would definitely, as a passive investor, do take the time to read the reports about your investment. So some sponsors do them monthly. We do them quarterly. And I, either method is just a preference. So either one is fine. So I would say, Scott, if you give me 50 grand, I would ask you to read the quarterly report.
Okay.
But other than that, it's meant to be, you were just like, oh, hey, that deposit showed up in my account again. Cool. That means I need to go read the report. That's probably in my email.
Yes.
So, yeah.
Four emails a year I can handle. It's it's the other stuff. I run plenty of businesses between the podcast, the coaching, and the mortgage and whatnot. So I don't need any more headache. I just need somebody to make money for me, which is weird because I think it's more socially acceptable. I'm thinking of some investor friends I have where, they've handed money over to brokers to invest in the stock market, and maybe they've lost and maybe they've won. Or maybe they trust the Vanguard auto bot to, do the investment for them. But it seems like there's kind of more of a social norm to hand over my money to a stockbroker and go play in the stock market. But if you just do a quick Google search of like property syndicators, it's like, oh no, don't do that. That's a scam. That's snake oil salesman. That doesn't work. Why is there a weirdness in either the internet community or the investor community? Why is there a little bit of a hesitation to be like, well, what's the difference between handing my 100 grand over to Andrew and he invests in a tangible asset like a property versus handing it off to Billy Bob, who works at investment firm ABC, and he's going to invest it for me in the market? I don't see the disconnect, but there is a disconnect if you read online. So is there a reason why there's a bit of a bad reputation around either property syndication or trusting somebody with your money in real estate versus trusting somebody with your money in the stock market? Or maybe you don't see the same thing, but that's just kind of what I was coming across when I did a quick Google search about property syndication.
And I think you're right. And I think, number one, there certainly is truth to it, and I'll get to that in a second. But the other piece is, I think there's an aura of legitimacy when it's like, well, it's this big company, they've been around for decades, so they can't be all that bad, right? And they're publicly traded, so there's auditors looking at them, the SEC is watching them. And it can't, so it should be fine, right? And well, we know how 2008 worked out with Lehman Brothers and Bear Stearns and all that. So I'm not quite sure there's as many they're being watched as closely as they should be. But all that, I think that's part of it. So it's like, hey, you know what? If I give my money to Chase or Vanguard, this is a well-known, well-respected brand. They're not going to disappear to Mexico overnight with my money. Right. So, and there's some legitimacy, I think, in that thought process, especially with like a Vanguard or something like that. So there's truth to that. And then on the flip side, unfortunately, because in the world of syndication, there's not a huge barrier to entry. If you just say, hey, I'm going to start doing this, there's not, if you can find the property, and if you can find the investors, you can get started in it, right? So there's not a huge barrier to entry, which means kind of like with becoming a realtor, right? 90% of them do it because, well, I want a side job, and they're going to list 3 houses a year, and something like the top 10% do like 80 or 90% of the volume, right? Because they're the ones that's their thing. They love it. They're good at it, and they crush it. And it's kind of similar in the syndication world, where it's not that hard to get in, but it is hard to be really good at it. And so a lot of the ones that either didn't get the education, didn't get mentorship, didn't learn the business properly, didn't get the skills, those can give a bad name to the industry as a whole. And then, yes, unfortunately, I think when you're dealing with individual sponsors or, very small companies, like we're a very small company. We've got, our core team is 5 people. And then, of course, we have all the, the on-site staff, the properties, but that's a small company compared to Vanguard, right?
Right.
So when you're dealing with individuals or very small companies, I think it's easier for fraud and misrepresentation to go under the radar and get missed. And, more so because, if you're investing with, Billy Bob's syndicator, you're really betting on Billy Bob, right? Whereas if you're investing with Vanguard, there's a certain level of, hey, there's reputation management there, right? There's reasons for them to not just disappear in the night with your money. So I think that's, so I would say what you're finding is correct. And that's where it really gets down to, that's a big piece of why you're really betting on the sponsor, not just the deal. And as a, and we talked earlier about, hey, these are passive investments, right? You send the money and your job is to just check for the deposit every quarter and look at the report. Your work is up front in deciding who you're going to invest with and then in what deal. Brian Burke, he's another syndicator. He's been out and doing this for about 30 years. He recently published a book called the Hands Off Property Investor, or and it's like 300 pages. It's not a short book, but he goes through in exquisite detail. He did a really good job with it about, as a passive investor, how you pick who and what to invest in.
It's funny. At your recommendation, I downloaded that on Audible, and I'm about 6 or 7 chapters in, and I think it's great. Let me give the book here. Oh man, I was listening to it just the other day. The Hands Off Investor by Brian Burke. And for a business book on Audible, it's almost 12 hours long, which is pretty long for a business book. And a little of it is like a little esoteric. I'm like, hey man, I didn't need so many stories. Just get to the punchline. But it is very good. And it gives you a framework to kind of think through, to your point, how do you do the work up front and find the best horse? Because, in thoroughbred racing, the choosing of the horse, the training of the horse, the feeding of the horse, that all goes into what? A 2-minute race? And the 2-minute race it's done one way or the other. Like once I wire you the money, it's kind of done. But I got to do all the pre-work, which is one of the reasons we're doing this interview. I've got a couple rapid fire questions, and then we'll close with, whatever thoughts you have or whatever question I forgot to ask you. How long you been doing this in the real estate game and the syndication game?
Yeah, so I took the standard route into real estate and got a chemical engineering degree. And then
wait, you were by trade a chemical engineer?
Yeah. I worked as a chemical engineer for about 7.5 years. So when I was in high school, I knew I wanted to be an entrepreneur, but I didn't know how or what. So I figured, hey, if I get a chemical engineering degree, at least I'll have a good job until I figure out what I really want to do, right? So yeah, and then in 2007, right as the crash was taking shape, I quit my engineering job to start flipping houses here in Southern California. That was great. But after a few years, I said, hey, this is almost like just another job, except it's a lot more hours. And my wife is my business partner. So we said, what's the next big thing? What's the next cycle that's going to take off? And we said, well, everyone just got foreclosed on, so they can't buy a house. That means they're going to rent. We also just had a huge recession, which means we're probably going to have a big, long expansion. So if you couple an expansion with a whole giant increase to the renter pool, apartments should probably do pretty well. So we went and found a guy who had done 800 units, friend of a friend, hired him to teach us the business. And in 2011, our first one was 92 units out in Macon, Georgia. And then we went full-time into apartments. And so I guess we've been doing it full-time for 10 years now.
Cool. And so not really a fair question because we've had 10 years of bull market in just about every asset, but have you had a losing year?
We've never lost investor money. I can go over, if you want, we can touch on the worst syndication we've ever done though.
Perfect. Go for it.
Yeah. So this was, I think we bought it in 2012 or somewhere around there. So this was early on. This was before we had any of the screening procedures that we have in now. And in fact, you always hear people say you learn more from your failures than your successes. And that is absolutely true because, the last 10 deals that have been home runs, part of the reason for that is because after this property, we said, okay, here's all the things we're not going to do. Right. So yeah, we bought a early 70s construction, C- property in a rough area of South Dallas. I had years of deferred maintenance. So needed tons and tons of work. And I don't remember if I said the size or not. It was 350 units, so it was a beast. And so we got in there and we're like, hey, we're going to do renovations. We're going to bump the rents $125 and then, and then 5 years later, sell it. So we got in, we started doing the renovations. We got the rent increases, but what we underestimated was just how rough the demographic was there. So we'd renovate a unit, someone would move in, and 6 months later, they'd stop paying. And instead of just leaving, they would destroy the unit either while they're living there or on their way out. So we ended up having to renovate every time a unit vacated. On top of that, like I said, it was a 40-something-year-old building with deferred maintenance. So the operating costs were through the roof because it was such an old building. It had what's called a chiller system, which means the entire property in Dallas, Texas, in the summer runs on one giant AC unit, right? And it has these underground pipes that lead to all the units to cool all the units. So guess what happens if that chiller system breaks down?
Was it $1 million? Or
what's that?
Was that $1 million and nobody has air conditioning?
Yeah, you have 350 families in Dallas in August that don't have air conditioning, right? Not just like, oh, hey, an air conditioner broke down, the entire property. Or the pipes underground break, and now they not only does the property not have air conditioning, but you're pumping thousands and thousands of gallons of water into the ground, which you're paying for that water, by the way. And you've got to spend $40,000 to dig a trench and replace that pipe. And, so one time, 5 o'clock in the afternoon, we actually had someone crawl up on top of the roof of the leasing office, bust out the skylight and throw Molotov cocktails into the leasing office to attempt to burn it down because they were upset because they were getting evicted because they didn't pay rent in 3 months. Right. So we've dramatically underestimated how difficult it would be to turn that property around. And then 2015 rolled along, and I don't know if you remember, but in 2015, everyone was certain a recession was coming in 2016. Right. I think Robert Kiyosaki even put out a book about the big 2016 crash. Right. And so we're like, okay, we can probably turn this around given a little bit more time. However, the properties that get hit the hardest in a recession are these kind of properties. C properties and C neighborhoods get hit hardest and first if a recession comes. So if a recession comes in 2016, we could be hosed. And so we made the decision to, Warren Buffett's number one rule, don't lose money. Number two is see rule number one, right? Yep. So what we did is we actually sold the property 2 years early because we were able to get a price that allowed us to return 100% investor capital. And I think it ended up being just a single-digit return, annual single-digit. Like I think we made distributions of 5 or 6%, and then like a couple of percent on sale. So way below our pro forma. But the lessons there were, again, we buy in the right areas, don't buy certain assets. There's a ton of stuff we could unpack there. I could talk for a whole hour on that property, but that's the worst syndication that we ever did. And rather than hold on to it and say we're going to turn this around, we decided let's just not risk losing capital. We're going to sell early. Some people won't be happy, but at least they won't have lost any money. And then we're going to move on to bigger and better deals.
So that brings me to my next question, which might not be so rapid fire, is, you and I both know, because we've been through a couple of these cycles in our lives, real estate is cyclical, all asset prices are cyclical. At some point, winter is coming. I've got my little, ice walker here from Game of Thrones. And I have this on my desk just to remind myself, don't get too high on the hog, keep debt at zero, keep the savings high because winter is coming at some point. I don't ever want to be in 2009 again where I was living on a couch because now I got a family. I can't live on a couch and call it an adventure.
You need a bigger couch.
Yeah, much bigger couch. So, what's your plan for the next downturn? Whether it's next month, next year, next decade, they keep printing money and the downturn doesn't come for 20 years until it's a real downturn. What's the plan to weather the storm when you've got, 3,000 units and I don't know what your leverage percentage is, but what's the downturn plan?
Well, yeah, and that's the problem with downturns is no one knows when they're actually going to show up, right? I mean, I know people who in 2015 and 16 said, all right, prices are too high. I'm getting out. I'm going to sit here and wait until they come back down.
Yeah.
Well, that's 6 years ago.
Yeah,
right?
six years ago, and a 50% increase in value on assets.
Yeah, exactly. So, and it's funny, you can't quite see it because of the angle, but that framed picture behind me also says winter is coming. So that's something we're always keeping in mind. So the problem is you don't know when it's coming, right? And like you said, it will, but you don't know when. And also, our government lately seems to be unwilling to have any kind of economic, downturn whatsoever. Like, it's just, we've got to keep it up all the time. So there's kind of what is that? That's the unknown, right? What kind of reaction is going to happen to any kind of downturn? But given that, the worst thing you can do is just say, I'm going to sit on the sidelines and not do anything, because especially with inflation coming, probably the best way to hedge against inflation is to own hard assets like real estate, right? So, okay, well, how do I hedge against inflation, own hard assets, but then also hedge against, recession or a downturn, or what if prices come down? And it comes down to, a handful of things, but two of the biggest ones is, number one, make sure you have sufficient cash flow to weather a storm. And then two, proper use of debt, matching debt with the business plan, right? So you mentioned our current portfolio. I think our current LTV is probably 35%.
Please, that's huge. Please explain to people what you're talking about when you say LTV and 30%, because that's amazing, by the way.
So what that means is, for every $100 million of real estate, there's $35 million in debt against it. Is basically what that means. So our loan to value, that ratio is roughly 35% on the existing properties. Now, when we buy a property, we typically go in at 70 or 75%, because it's called value add, meaning we're gonna renovate, we're gonna do some different things, bump up rents, so that the idea is after you do that value add, you have a lower basis in the property and a higher cash flow. And that's how you get to a position of 35% overall leverage, right? So going in, we're usually 70 to 75%. I see a lot of deals being done nowadays at 80%. That's a little high for my comfort level. Again, I'm not, it can work out fine, and it has been. That's not our preference, is to go that high.
So just so I make sure I understand this, on this next deal you're putting together, let's say the next deal is $40 million. You're going to raise 30% down. So you'll get $12 million down. So now you owe $28 million on this $40 million asset. And in your mind, through value adds to the property, increase in rents, lowering the property, the property maintenance costs, or just the overall expenses, your goal is like, hey, through the manipulation of the denominator and the numerator, getting incomes up and expenses down, we're going to make this property intrinsically worth $50 million. And so now we have an asset that's worth $50 million. We bought it for 40 with 12% down. So now we owe $28 million on a $50 million property. And now our LTV is closer to 55% instead of 75%. So it's not that you're taking extra money to pay down the loan. You're just adding value and taking the tailwind of appreciation. And now all of a sudden you only owe in your portfolio $35 million per 100 million owned. Am I conceptualizing this correctly?
Exactly. So what we're doing is we're going in with what we feel like is moderate leverage, 70 to 75%. Now I know some operators that like to go into 60, 65. And if you have a low enough cost of equity, that's great. You can do that. We like to go in with 70 to 75, knowing that we're going to put some work into it, and that 2 years later, we should have a property that's that we have forced appreciation on. And then now our leverage is down to where, a lower level. The other piece of it is, I mentioned structure, and you're right. This won't be a rapid fire, but I'll try to make it quick. So going back to that, the $50 million deal we bought in March, when we went under contract on that, it was late December 2020. And when we applied for the loan, it was January 2021. That was still a very uncertain environment in terms of the economy and COVID and all of that. So what we did to make sure that to structure the debt properly in case a recession or downturn came, and there's a million ways to structure the debt. This is just an example to kind of illustrate it. So we got 12-year fixed rate Fannie Mae debt, right? So we know that if interest rates go up, it is not going to affect that property for 12 years, because we have a fixed rate of 3.79% for 12 years. Like, it doesn't matter like what happens. Our interest rate on that loan is 3.79 for 12 years, right? So we have that. Also, with a 12-year Fannie Mae loan, you can get two supplementals. And what a supplemental is, if you go to the single family world, you get your first mortgage, the value of your property goes up, you can go get a second mortgage or a HELOC, right? Or something like that. In the commercial world, the equivalent is a supplemental. You can go back to Fannie Mae and say, hey, the value is way up, I want to pull some cash out. And you can return it to investors. You can, put it on a new roof, whatever you want to do with that. So that loan allows us to do that twice. Now, our business model is to sell in 6 years. So here's where all that comes into play. When you're buying a property, you always want to say, what are the potential outcomes, good or bad? So let's say we get to 6 years from now, and let's just say interest rates are way up, right? If someone was going to go get a loan, they'd have to pay 6% interest. Well, our loan is assumable, meaning that the buyer could take over our loan and they get to pay 3.79% for the next 6 years of the remainder of that loan. So by allowing a new buyer by guaranteeing that a new buyer of our property will pay no more than 3.79%, that helps protect the value of our property, because our buyer doesn't have to come in with more expensive debt. Now, the downside of that assumption is, well, what if the property is worth $70, $80 million? Now they have to bring a ton of equity. Well, that costs too, right? That's where the supplemental comes in. They can use that supplemental to get back up to 75%. So we get the best of both worlds. They can get full moderate leverage at 75% and take over our low interest rate of 3.79. So in a high interest rate environment, we still have a good exit. What if it goes the other way? What if interest rates somehow are way lower in 6 years when we want to sell? And someone's like, I don't want that loan. It's 3.7. I can get it for 2.5. So what that means in that situation, we go to sell, is we're gonna have to pay off that loan. We will pay. It's called yield maintenance, but it's effectively a prepayment penalty. But if interest rates are that much lower in 6 years, that also means it's extremely likely that cap rates are going to be way lower in 6 years. And if cap rates are way lower, that means the value of our property is way higher than we were planning. And we'll be more than happy to pay that prepayment penalty, because there'll be so much extra profit from the sale of the property, right? So in either way, we win when we want to exit in 6 years. Okay, well, what if we get to the point in 6 years where it's 2008 all over again? No one's buying. You can't sell. You can't refinance.
There's blood in the streets. There's property values have taken a 40% hit.
Yeah, exactly. Let's say property values are down. Let's say the thing's worth $40 million, right? Okay, fine. We have 6 more years. We can just wait it out on that loan. Our payment is low because it's at 3.79%. All right, and it's a 30-year amortization. So the worst case scenario is we just hold for another 6 years, and then zoom back out. Look at U.S. real estate for the last couple hundred years. I would challenge you to find a 12-year period where commercial real estate in good market, we're not talking Detroit, we're talking, growing markets, the Southeast. Find a 12-year period where the value of a well-run asset is lower at the end of 12 years than it was at the beginning of 12 years. Yep. Especially with growing inflation, the odds of that are exceptionally low. So that's how you mitigate against the downturn. That's how you mitigate against potentially lower prices, is you structure your business plan and your debt so that you have multiple exit strategies for almost any scenario, right? And again, the beautiful thing about real estate, David Osborne, a mutual friend of ours, says this a lot. Don't wait to buy real estate and wait, right? As long as you buy the right property and you operate it well, it's the most forgiving asset on the planet, because almost always in the United States, if you just hold it long enough, you'll be fine, and you can eventually get out of that thing with a profit. So, that was a bit long-winded, but that's how you mitigate, or that's one of the main ways you mitigate a potential downturn, is right market, right property, right business plan, and then structure the debt so that you have those options.
I love that. And just real quick, in your syndication, I know it's different in every single one. What's the minimum investment that you're looking at for an investor? If somebody's watching this and they're like, "Oh, this sounds interesting," what is the minimum, the table stakes for an Andrew Cushman deal?
These days, it's usually 100,000. Although anybody investing with us for the first time is allowed to do 50.
Cool. And what is the minimum net worth income? Like, what's the restriction of somebody who's thinking of investing? Do they have to be a billionaire, a millionaire? Do they have to make a certain amount of money? What's the story?
Well, I don't know enough billionaires to restrict it to just billionaires. So there's a handful of ways you can syndicate, and we won't get into the weeds, but there's basically two ways. One is 506C, which is when you advertise and solicit. And in order for an investor to invest in something like that, they have to be accredited, meaning they're either, make $200,000 as an individual or $300,000 married, and their net worth is $1 million or more, excluding primary residence, right? So that's 506C. We actually do 506B, which means we don't advertise, we don't solicit. You have to have a pre-existing relationship with us. So, for example, we do, as you kind of alluded to, we have a deal right now that we're working on, that we're about to open up to our current investors. But if someone hears this podcast and reaches out to me and says, "Oh, I want to get in that," the answer will be, "Sorry, we're not allowed to do that." Right? We can talk to you and get all your information, and you can get added to our list for maybe the next one. But we can't let you in a current one. So because of that, because in order to get into one of our deals, you have to have a pre-existing relationship, we're allowed to take a limited number of what's called sophisticated investors. Meaning, okay, so you don't make $300,000 as a married couple. You don't have a net worth of $1 million, but you have some investable cash, and you are sophisticated enough to be able to decide whether or not this type of investment is right for you or not, right? And that's part of the interview process. As we're interviewing each other. So when we do the interview, Scott, you asked me a bunch of questions of, have you ever lost money, and what kind of deals do you do, and what kind of fee? You ask those questions, but then we're also asking questions to make sure that you're a good fit for the type of investment. And if not, we'll let you know.
I got to say that's one of the things I really appreciated with you, and why I want to do this podcast. Because when we started talking, you were like, "Hey, I just want to bring this all into focus and kind of give you some worst case scenarios. Could you lose this money? What are your other investments? And before we even talked about anything, you were like, what are your expectations on a rate of return?" And when we started talking about the baseball analogy, the singles and the doubles, he's like, "Cool. I immediately disqualify people that are looking for a home run, because that's not the methodology." And so I really appreciated that give and take in that interview. And side note, I think it's funny that they haven't updated that accredited investor, because I think that term came out in the 70s or 80s, and they haven't raised the income cap, even though, if you cost adjusted it, it probably means you have to have a net worth or income over $1 million and a net worth over $2 million. But whatever, I digress. All right, so anybody making over $200,000 as an individual or $300,000 as a married couple can get on your list, and maybe at some future point you might have an investment for them. I want to run one thing by you because it's timely, and we'll probably release this in a couple weeks. So maybe it won't be as timely, or maybe it'll be the biggest story in the news. I was reading something that when the U.S. economy collapsed in 2009, we had about 6% of GDP was the single family market, housing market. So 6% of all the GDP in America was the housing market, and the disruption to that housing market was enough to crush our economy and then almost bring down the world economy. Right now, there's a Chinese real estate company that is responsible for 20% of the GDP of China. Between their financing, their growth, their construction, they have something like 1,500 multi-billion-dollar projects going on across China and across the globe, and they're about to default on their debt. And some financial prognosticators that I talked to a lot said, "Hey, there's this weird domino effect that could happen that would affect me in the mortgage industry, where it's like, if the biggest real estate and investment company in China falls and they default on their debt, all of those banks and all those assets are going to be looking for a home. All of a sudden, U.S. Treasuries at 1.5% or 1% or 0.5% for capital preservation looks really attractive. could we see in the residential side of things, in a 30-year mortgage with a 1 in front of it, 1.99, because there's just this flood of a massive amount of money that comes into the U.S. market. Have you read anything about this, or is this anything that's on your radar with the collapse of this giant Chinese property company?
It's on my radar, but I'm certainly not an expert. I believe it's Evergrande or Evergrande. I'm not sure how you say it. Yeah. And I think their debt's like 300 billion, something along those lines. So,
yeah.
I have not checked the news feed at all this morning. So who knows what the current thing is. The chatter that I've heard is that the Chinese government probably won't let them default. They'll probably restructure, bail out, or do something along those lines. Who knows for sure? It's China is pretty opaque. You're not ever really sure what's going on over there.
Right.
So it's kind of hard to say. And the perspective you just shared, that's really interesting. I actually had not heard that perspective, and I certainly could see that. And that's the thing is, it gets back to it's a temptation. Like, I'm just going to wait until this whole thing blows over, right? Well, there's going to be another one next month, or there's always going to be something, right? There's, the market climbs a wall of worry. But that just gets back to the conversation we just had a minute ago about trying to structure for all and mitigate all outcomes, right? You can't eliminate risk, and the only way to completely eliminate risk is to go commit a crime, get put in jail for life, and now you've got your 4 walls, a roof, and 3 square meals a day. Like, you don't have you're good. There's other risks, but you've got your expenses covered. Outside of that, you can't eliminate risk, and that's why you get a return, right? I mean, you risk capital to get a return. So when I see this all happening, that's an interesting idea about it driving rates down. I could see that happening, but I could also see it being contagious and starting chain of dominoes like kind of happened back in 2008, right? So I can kind of see it going either way. It could be an effect, a benefit, was what you described, or it could be a negative. So what do you do? In a sense, business as usual, which is evaluating the risk of all outcomes to begin with, right? So that when Evergrande 2 pops up 6 months from now, you're like, okay, well, yeah, that's baked into our model. Like something like that could happen. Also, China, again, this is outside of my pay grade right now, but my understanding is China has falling asset prices, and that's part of what's causing the problem, because they did so much overbuilding and overdevelopment and so much state-sponsored building. I mean, they have vacant cities over there.
Yeah.
So, I mean, that's an entirely different world than the U.S., where we have a verified housing shortage.
Yep.
And there's just not enough supply. So.
Yeah, makes sense. Last question, and we'll close on this. I always like to ask this is, what's the question I forgot to ask? The story you want to tell, the thing that you're like, man, when I get interviewed, I wish people would ask this. What's the thing I forgot to ask over the last half hour about either you personally, or the risk that is involved in syndication, or some funny story, or something you want to share about the economy? What's the question I forgot to ask?
Well, the usual one is what I actually went over. Is that people don't ask that they should ask, is what's the worst deal you've ever done? And we actually already talked about that. A lot of people ask me, is that a prop? No, it's not. It's a real surfboard. I used it on Wednesday. At this point, we've covered a lot, so I'm not sure, but I'll answer any question that's thrown at me. So I guess I can say that.
Cool, man. And how do people get in touch with you if they want to start the exploratory process of getting on your list, investing in a deal so they can invest in future deals? How do people contact Andrew?
Yeah, if you Google me, I'll come up all over the place. But the easiest way is our web. If you Google Vantage Point Acquisitions, and the website is vpacq.com.
vpacu.com.
Yeah, ACQ. Sorry,
ACQ. Sorry.
V like Vantage, P as in point, and then ACQ, short for acquisitions. There's a couple of tabs on there for how to reach out and connect, and that comes to my inbox, and happy to have a conversation. Of course, I'm on LinkedIn and bigger pockets and all that. But if you actually really want to connect, the best way is to the website.
Cool, man. And then one last question. I promise it'll be the last one. You and I both lived in the communist state of California. What are you most looking forward to after the lockdowns, after the masks, after things normalize, after COVID? What are you most looking forward to getting back to doing?
Oh, I probably see 2 movies a year in the theater, but I'm looking forward to doing that. And then also my wife and I really used to enjoy going to the improv because there's a couple of improvs. And one of the cool things about living near LA is all the big name comedians go to the local improvs to test out their new material before they do their Netflix special.
Yep.
Right. So like we've seen Gabriel Iglesias, like we're going to see, actually we're going to go see Jay Leno in a couple of months. Like all the big name guys, we'll be sitting 10 feet from them in a intimate little environment at the improv while they will literally walk out with their notes and be like, okay guys, this is new material. Testing it out. And like, they're so like just candid and real. It's awesome. And then of course we'll see the Netflix special 4 months later and like, hey, we heard all this.
Yeah.
So I'm looking forward to being able to do more of that again and just go to the improv, relax, not worry about everything, and enjoy that. One of the benefits of living in this area. So
totally. I used to go to the Ice House a lot when I was living in Pasadena before we moved up to Valencia. And same thing. I saw Joe Rogan like a dozen times in 3 months when he was working on new material. And it was just crazy because to your point, he would walk up and he'd be like, hey man, I think this one is dog shit, but let me try it out. And
well, yeah. And I've even had that they'll do a joke and like, okay, that didn't work. They're like, all right, I'm actually going to try another version on you guys. Okay. So just give me a second. And they literally would just tell the same joke over. And they'd be like, is that better? You know, like this is cool. I mean, it is really cool to see masters of their craft. Like, okay, they're real people. Like they struggle with putting it together too. Just like you and I do with everything. Like the self-doubt. Oh, should I be buying this deal or should I not? Did I miss something? You know? It's definitely a bit of a rabbit trail, but yeah, it's looking forward to that again. And again, it's cool to see people that are way up here. Like, hey, they're having similar struggles that we do, you know? So.
Yeah. Well, Andrew, man, I really appreciate you being on. I'm looking forward to open up the round on this next deal because I will be a client and a friend. And yeah, at some point in the future, we'll have to do this again in person.
All right. Sounds good, man. Good talking to you.
All right. Talk soon.
All right. Take care.
Bye.